Welcome back. What we're going to do now is take all of these different kinds of costs, product or period costs, and see if we can understand the behavior of these costs given various changes in the volume of our business. Well, what do I mean by volume? I mean by volume the number of units of our goods that we either purchase or produce, whether we're a merchandising or a manufacturing business, and how many of those units we actually sell. Now, in the real world, you might purchase or produce merchandise or products in excess of the number of units you actually sell, or you might actually produce less than you sell. If, in fact, in a particular period you manufacture more products than you sell in a particular period, what you're actually doing is you're building up your inventory. You're producing more than you sell, and therefore you end up with more finished goods inventory during that period of time. For our purposes in this lesson, we're going to try and simplify our approach to facilitate our understanding of the material. And so what we're going to do in terms of measuring our volume is we're going to simply assume that the amount of or the number of units that we produce or purchase will be the same as the number of units that we sell, such that everything that we produce, we sell in a particular period. That will kind of simplify our conversations associated with changes in volume. Now, what I'd like to do is distinguish all of the various costs that we've discussed up to this point in time, whether they be product or period costs, and distinguish them in terms of their cost behavior into two broad categories. We're going to suggest that all of these costs and their behavior relative to changes in volume, variable costs or fixed costs. Understanding all of your costs and being able to identify how they behave with changes in volume, whether they're variable or whether they're fixed, will allow us to do some very, very interesting managerial analysis, and will allow management to understand the effect on our profits given changes in our volume or the number of units that we produce or sell. In fact, we're going to develop a tool called cost volume profit analysis, or simply referred to as CVP analysis. What this does is, if we can understand our costs and then identify how those costs behave relative to changes in volume, we can then determine what the effect is on our profits given changes in volume. We're going to have to first identify all of our costs, whether they be product or period costs, and distinguish those costs as either variable or fixed costs. That's the first step in approaching this tool that we want to explore here called CVP, Cost Volume Profit Analysis. What is a variable cost? Well, a variable cost is a cost that varies in total with changes in volume. Let me give you an example of what I would think would probably be a variable cost. Let's assume that you manufacture a product. Well, you're going to incur in the manufacture of that product some material costs. You have to have the materials to actually make this product. My guess is that your total direct material costs will increase if you manufacture and sell. As you manufacture, your more your material costs are going to be. If in fact, given different levels of volume, the total direct material cost will be different, change, increase with increases in production and sales, you have what is effectively a variable cost. It varies in total with changes in volume. And so let's go ahead and create a graph here that would identify the relationship between total direct material costs and volume. And we'll do that as we present or create this graph here by making the vertical axis representative of total direct material costs. And we'll identify some levels here, $20,000, $40,000, $60,000, $80,000 are varying levels of total direct material costs. And on the horizontal axis, we'll identify different levels of volume. We'll start out with 0 and then 1,000 units of production and sales, 2,000 units, 3,000 units, 4,000 units. And what we're going to do here is draw a line that maps the relationship between total direct material costs and changing levels of volume. A perfectly variable cost always starts at the origin. So a perfectly variable cost will always start at the origin because there is no cost if there is no volume. In this particular case, apparently, at a volume of 1,000 units, we will have a total direct material cost of $20,000. Let's plot that point here. And at a level of volume of 2,000 units, we have a total direct material cost of $40,000. And at $3,000, we have a total direct material cost of $60,000. Clearly, this is a variable cost because the total direct material cost is increasing with increases in volume, which we would anticipate for total direct material cost. One of the things to note here is that the slope of this line, is constant. It's a straight line. It's linear. What that means is that the rate of increase in total material costs increases in a constant way with increases in volume. For every additional unit we sell, the increase in our total direct material costs increases at the same rate. And that would be true in a perfectly variable cost. Not only does it start at the origin, but as we show the relationship of increasing direct material costs with increases in volume, it would move in a linear fashion. In this particular case, the slope of this line represents the variable cost per unit. Let me describe what I mean there a little bit more precisely. How do you actually calculate the slope of a line? You can calculate the slope of the line by taking the amount of the rise over the run. In other words, if you take 2 points on this line and then look at the difference between those 2 points on the line and the difference being reflected in the amount of increase in the vertical axis, in this particular case, the amount of increasing total direct material costs between these 2 points, and if in fact we pick a point, these 2 points here, 1,000 units at $20,000 of cost and 2,000 units at $40,000 of cost, the rise between those 2 points would be the increase from $20,000 total cost to $40,000, or the change would be $20,000 is the rise between those 2 points. The run is the change in the horizontal axis, or the number of units between these 2 points, which would be an increase from 1,000 units to 2,000 units. So the slope of this line would be the rise, $20,000, over the run, 1,000 units, or 20 to 1. This means that for every additional unit that we sell, the total direct material cost increases by $20. This is the variable cost per unit. And for a perfectly variable cost, that $20 per unit would be the same regardless of the level of volume that we were at. In fact, another way to identify variable costs would be to look at and graph variable costs per unit. If in fact we were to create a graph here where again we're showing changes in volume on the horizontal axis from 0 to 1,000 to 2,000 and 3,000. But on the vertical axis, in this particular case, instead of measuring the total direct material cost, we simply are measuring the direct material cost per unit. How would we graph out this direct material cost? In this particular case, we've determined that the variable cost per unit is $20 a unit, or was the slope of that line that we identified relative to total direct material costs. And the variable cost per unit is the same whether we manufacture and sell 1,000 units, or whether we manufacture and sell 2,000 units or 3,000 units. It's $20 of material cost per unit. This graph here is simply reinforcing the fact that a perfectly variable cost has a fixed or constant variable cost per unit, which simply means that the slope of the line that identifies total direct material costs is linear. So let's summarize variable costs from a definitional standpoint. Variable costs are any costs that vary in terms of their total, given changes in the volume of the business, number of units produced or sold. But a perfectly variable cost will have a constant or fixed per unit cost, given any changes in volume. Variable costs vary in total, but are fixed on a per unit basis. if they're perfectly variable? Okay, if you're in a manufacturing business, certainly your material costs would tend to be variable. You'll have more total costs if you manufacture and produce more of your product. What are some other potentially variable costs? Well, some other variable costs might be, I suppose, direct labor. If we're going to manufacture and produce more units, we're going to need more personnel, more people who are involved in the direct labor process of making and assembling that product. And therefore, I'm going to suspect that our direct labor costs will increase or vary with increases in volume. What are some other potential variable costs? Well, outside of production costs, let's look at period costs like selling and administrative costs. One common selling and administrative cost or period cost is sales commissions. Now, would sales commissions be a variable cost? Well, if in fact we have an arrangement with our sales personnel where we pay them a commission, a dollar amount or some percentage of their sales, then in fact sales commission would be a variable cost, because the more units that our sales personnel make, the more sales they make, the higher the commission will be to those salespeople. And so sales commission, we can reasonably anticipate, would be a variable cost. And, there might be other costs that might tend to be variable in a business. Let me make one point here that I think is worth considering and really is necessary as we finalize this discussion of and our understanding of variable costs. In the real world, there is never what I would call a perfectly variable cost. A cost that is constant on a per unit basis throughout all the various range of volume. For example, if in fact we manufacture a product and the direct material costs are $20 a unit, what if in fact we become extremely successful and we start manufacturing more and more, that my variable costs, if we were to portray them graphically, might not actually be a straight line or a constant amount of variable cost per unit, $20 a unit. In fact, over time, if you're evaluating, looking at volume from 0 to infinity, if we were to draw the variable cost line, it actually might have, kind of a curve associated with it as we measure the total direct material cost. This curving to the right here of this variable cost line indicates that its slope is actually being reduced with increases in volume. And if we're talking about increases in volume, up to the millions, maybe the cost of our direct materials, if we only sell a few thousand units, is $20 a unit. But if we're selling millions of units, the cost of our materials might only be $15 a unit. And so it's possible that in the real world, our direct material costs with increases in volume might actually decline in terms of the variable cost per unit or the slope of this line. Is that really appropriate in a world where maybe a true, actual, real variable cost does not function, as a straight line with a constant variable cost per unit? Well, let's face it. In our business, the range of volume that we expect over the next year or a few years is not 0 to infinity. We know we're going to manufacture and produce more than 0 units. We may even know that we're going to produce and manufacture more than 1,000 units. Heck, how many units did we produce last year? And we know that within the next year or two, we're not going to produce millions of units. What we should be looking at here is what I'm going to refer to as a relevant range. It is a range of volume that can be reasonably anticipated for operations currently or in the very near future. Our range of volume here isn't 0 to infinity. Let's assume in this particular case that our range of volume over the next year is we think we're going to manufacture and sell, anywhere between 400,000 and 600,000 units. If we were to reflect that on this graph, measuring the total direct material costs within the relevant range, the range that we can reasonably anticipate in the current operations or near future, and that relevant range is between 400,000 and 600,000 units of volume. When we look at the total direct material costs within the relevant range, well, that's really all we should be looking at, is how these costs behave between the relevant range or our anticipated or expected levels of volume. And within the relevant range, this particular graph here, it almost looks straight. Now, in the real world, it may be a little bit curved, meaning that the cost per unit may not be constant throughout that range. But to simplify our cost volume of profit analysis, we will make an assumption that within the relevant range, it is a straight line, that it is perfectly variable within the relevant range. That will greatly simplify the math when using CVP analysis. Now, if in fact there's a bit of a curve there in reality, what we're going to do is simply flatten it out, draw a straight line, and then calculate the slope of that straight line. Even though in reality it's not perfectly straight, we'll assume it's straight. Calculate the slope and say that is our variable cost per unit for direct material costs within the relevant range. In other words, within the relevant range, the slope of the variable cost line is assumed to be linear. Or in other words, the variable cost per unit is assumed to be constant within the relevant range. Let's move on now and define fixed costs. Fixed costs, they're costs that are the same, fixed. They're constant, regardless of changes in volume. Let me give you an example. Let's assume that we are renting a building and that we pay $4,000 a month. And it's $4,000 a month no matter how many units we manufacture or sell. I mean, we've entered into an agreement with the landlord that we're paying $4,000 a month, and we pay $4,000 a month even if we don't manufacture or sell anything. Or if we manufacture and sell 10,000 units, it's still $4,000. So regardless of the volume, the cost of our building rent is fixed and doesn't change over a range of volume. If we were to portray this graphically, let's go ahead and create a graph. And in this particular case, again, the vertical axis in this case will represent our total building rental costs per month. And it might be $2,000 or $4,000 or $6,000. An increasing total cost. And the horizontal axis again will measure our volume, 1,000 units, 2,000, 3,000 units produced and or sold. If we were to graph this fixed cost, total building rental cost, and the contract with the landlord was that we're paying $4,000 a month, it doesn't rely on how many units that we manufacture or sell, then if we were to graph this, it would simply be a straight line. It's $4,000 whether we manufacture and sell 1,000 units or 3,000 units or 6,000 units, the total building rental cost per month is $4,000. Now, we can actually do a calculation to determine the effect of fixed costs on a per unit basis. And I'd like to do that here. I'd like to create another graph. And again, let's keep in place in the horizontal axis, measuring our volume going from 0 to 1,000, 2,000, 3,000 units. But on the vertical axis in this particular graph, I want to change it. It will not represent total building rental costs per month, but rather it will represent the building rental costs per unit of production or per unit of sales. If we do this, let's kind of figure this out and plot how we would graph these fixed building rental costs per unit. Well, let's assume that we manufacture and sell 500 units, and the building rental costs are $4,000 for that month. What would be the fixed cost or the building rental cost per unit of production or sales in that particular case if we produce or sell 500 units? $4,000 divided by 500 units equals a rental cost of $8 a unit. That's kind of contrary to what you've said, because in reality, we aren't charged rent on a per unit basis. And you're absolutely right. But if I want to just kind of make a mathematical exercise here for my own sake, but if in fact I'd like to understand how much of our rent needs to be covered with the sales price of our products at different levels of volume, then this is kind of an interesting little mathematical exercise. Let's assume that in fact we sell and manufacture and sell 1,000 units. Again, the building rental costs, and that's in a particular month, the building rental costs in that month would be $4,000. Well, what would be the fixed cost per unit in that particular month? It'd be 4,000 units divided by $4,000 of cost divided by 1,000 units, or $4 a unit. Let's plot that on this graph. And what we're really saying is if we're going to sell 1,000 units, we better sell them at a price that covers at least $4 of rental costs per unit, plus any other costs associated with that product. If in fact we manufacture and sell 2,000 units, what would be the mathematical calculation of our fixed cost per unit? Again, we'd take the $4,000 of rental costs per month, divide it by the 2,000 units produced or sold in that month, and we'd be saying that that would be $2 per unit. And we would plot it here on the graph. At a level of 4,000 units of volume, the fixed cost per unit would be $1. $4,000 per month divided by 4,000 units is $1 per unit, and we would plot that here on the graph. And then if we were to take and create just a line connecting these points, you can see that what we've got here is that with increasing volume, our fixed cost per unit continue to decline. What this tells us, again, we don't make a calculation of our building rent based on the number of units. I mean, it's just $4,000 a unit. But what we're really saying is that if in fact we're able to increase our volume, the cost associated with rent becomes spread out over more units in terms of us trying to accomplish a profit. Think about and consider that in fact we have a monthly building rent of $4,000 and we only manufacture and sell 1 unit that month. This is not good. We've got 1 unit that we've manufactured and now that we're selling, and we've got $4,000 of rental costs that have to be covered by the sales revenues associated with that 1 unit, plus any other costs associated with the manufacturing of the product or other costs of selling and administrating the business. This would be bad. In a company that has fixed costs, those companies become very, very sensitive to volume in terms of ultimately generating a profit. We must do higher volumes of business in order to cover those fixed costs and reduce effectively the fixed cost per unit. So again, let's kind of summarize our definition here for fixed costs. Fixed costs are fixed in total over a period of time given changes in volume, but they vary per unit with changes in volume during that period of time. They're fixed regardless of how many units we produce, but if we make a calculation of how much our fixed costs are per unit, that will vary and will decrease with increases in volume. Now, in the real world, there really never is a truly perfectly fixed cost. I mean, consider this. If in fact we consider that our range of volume is 0 to infinity, we might manufacture and sell 1,000 units, or we might manufacture and sell, millions of units. In that particular case, the cost of our total building rent will not stay the same, $4,000 a month. If I double, triple, quadruple, or start manufacturing millions of units, I need a bigger building. My building rental costs, although fixed for a certain level of volume, will not stay the same with greatly increasing levels of volume. In fact, if we were to kind of graph the real world here, showing in the vertical axis our total building rental costs on a monthly basis and our range of volume going from 0 to infinity, it kind of has a stepping action here, because in the real world, you may be able to operate at a level of, let's say, $10,000 of building rental cost, for certain levels of volume. But if you double, triple, quadruple your volume, you're going to need a larger building. And you may have to double the square footage that you're operating from. And so over a higher level of volume, you're now up to $20,000. And if you double, triple your volume again after that, you might have to add some additional square footage, and your building rental costs go up again to $30,000. So in the real world, where you're considering the range of volume from 0 to infinity, there really is no what I would call perfectly fixed cost. But certainly within the range, the relevant range, this range of volume that we can reasonably anticipate for our business in the current period or or in the near term here, that there might be fixed costs within that relevant range. I mean, if in fact, if we were to show here graphically a range of volume from 400,000 units to 600,000 units, we know we're going to do at least 400,000 units of production or sales, but we don't think we'd ever exceed 600,000 units of production or sales. Within that, our building rent might be constant on a per monthly basis. In this graph, $20,000. Supplies the space that we need in order to do a volume between 400 and 600,000 units. And so within a relevant range, we might have and should have perfectly fixed costs.